and relief packages implemented, only a mere 2% has been earmarked for poverty support for children, as opposed to 80% for businesses.
The UN Children's Fund UNICEF has slammed the levels of financial support for children allocated by high-income countries during the pandemic as totally inadequate in a child poverty report issued last week. The report shows that of the $14.9 trillion spent on domestic financial recovery packages put together by wealthier countries between February and August, just 2% was allocated specifically to support children and families raising children. This is despite evidence that child poverty is expected to remain above pre-COVID levels for at least 5 years in high-income countries. Director of the UNICEF Office of Research in Florence, Italy, Gunilla Olsson, stated that the amount of financial relief allocated directly to children and families does not match the severe fallout of the pandemic, nor how long the crisis is expected to impact these countries. The study also found that businesses were by far the largest beneficiary of fiscal stimulus packages, absorbing around 80% of the available funds during this period, and that the most marginalized children will suffer most as a result. Around a third of the large economies surveyed from the European Union and OECD group of high-income nations in the report did not implement any policies specifically aimed at supporting children during the first wave of the pandemic. On the whole, the social protection measures for children and families that were enacted in other countries, such as childcare, school sustenance and family allowances, only lasted for an average of 3 months, far too short term to adequately address the projected length of the crisis and child poverty risks in the long run, the report noted. As temperatures drop in many parts of the world and cases rise, UNICEF is urging governments to bring in more balanced recovery plans during the second wave, with a greater emphasis on social protection for children and unconditional income support for the poorest families, allowances for food, childcare and utilities, and rent or mortgage waivers.
We will see you shortly. Bear with us. Welcome back. You're watching First at 9. Now, ratings agency S&P has slashed Sri Lanka's credit rating to CCC+ today, citing concerns that risks to the country's debt servicing capacity have risen as the COVID-19 pandemic squeezes the government's ability to generate earnings. S&P's downgrade from B- follows similar moves by Fitch and Moody's in recent months. Now, the ratings agency said that Sri Lanka's fiscal deficit is likely to remain elevated in the wake of the government's recent expansionary budget measures, and added that the measures will likely worsen the government's heavy indebtedness and add to repayment burden. It also noted that Sri Lanka's external profile remained weak, given that the high share of dollar-denominated debt exposed the government to shifts in risk sentiment. S&P expects the fiscal deficit to remain elevated at 10.2% of GDP in 2021 and narrow gradually to 8.4% in 2023. It anticipates the net general government debt to exceed 100% of GDP in 2021 and remain high over the next 5 years. Now, the Asian Development Bank says that Sri Lanka's second wave of COVID-19 is expected to worsen its economic contraction this year. However, South Asia's growth forecast for 2020 has been revised up, with 6.1% contraction on the back of improved prospects for India's economy.
The Asian Development Bank warns in its latest outlook that the second wave of the pandemic in Sri Lanka is expected to worsen the contraction of the economy this year. The ADB says that in Sri Lanka, economic recovery was underway in the third quarter, but a rapidly expanding outbreak from early October brought localized lockdowns and restrictions, and the economic effects compounded by resurgent outbreaks in the country's main export and tourist markets. The ADB said in a supplement to its Asian Development Outlook released yesterday that these factors are expected to worsen contraction in 2020. However, the ADB noted that with improved prospects for India, South Asia's growth forecast for 2020 is revised up from 6.8% contraction to 6.1%. Further, the sub-regional growth projection for 2021 is revised up slightly from 7.1% to 7.2%. The GDP forecast for financial year 2020 has been upgraded from 9% contraction to 8%, with GDP in the second half probably restored to its size a year earlier. The growth projection for financial year 2021 has been kept at 8%.
Today the market entered the 14th day in its green run as the index has crossed the 6,600 mark and is now at 6,614 points. However, with the market having one of its longest runs, what we are seeing is now the upward momentum is starting to slow down. So today the gain in the index was just 5 points, though the index has now entered a 3-year high. And with that, what we are also seeing is turnover levels have also picked up again, and continuously during this week we saw 3 billion plus turnover levels, and even today the turnover levels are closer to 3 billion. In addition, if you take the number of transactions, also have been around 25,000 transactions. So with that, we see a significant amount of retail activity in the market, and these retail favorite counters have been gaining a lot of buying interest over the last few days.